Hi, everybody. This is Paul Gerard. I'm a student loan consultant working with the American Dental Education Association, ADEA. We have a series of repayment modules that are designed to help you guys do a better job of managing your student loans. This repayment module is on interest rates, how they work on your student loans. Now, we have a number of things to cover in this repayment module. First of all, we'll start with some important reminders about interest rates, and then we'll talk about capitalization of interest. This is where the interest that builds up is added back to the principal balance that you borrowed. So you can't really talk about interest rates without also talking about capitalization. We'll talk about how interest rates work on federal, campus-based, and also private loans. And we'll take a quick look at trends on interest rates and also the current rates on your student loans. We're recording this in July of 2018, so we'll look at the rates for the 2018-19 academic year. And we'll finally close this module with some tips on how to reduce the impact of high interest rates and capitalization on repayment. Now we start with some important reminders. First of all, interest rates on your federal student loans will be fixed for the life of the loan. This has been the case ever since July of 2006. Prior to that time, interest rates were variable on student loans and they changed every year on the same loan. That's not the case now. So when you take out a direct unsubsidized or a direct plus loan for dental school, the interest rate that you're assigned will be fixed for the life of the loan. Most of the loans that you take out for dental school are what we call unsubsidized. That simply means interest is building up or accruing during dental school and also the 6-month grace period after you graduate. The government is not paying it for you. You don't have to pay it during dental school, but you will ultimately be responsible for it. There is a terrific debt management tool called the AAMC ADEA Dental Loan Organizer and Calculator. We call it the AAMC ADEA DLOC. It's available at adea.org/DLOC, and it always uses current interest rates. That's a great debt management tool we hope that you will use. Now, as we mentioned in an earlier slide, you can't really talk about interest rates without also talking about capitalization. Capitalization is what causes your balance to grow, in some cases dramatically. So it's very important that you understand capitalization, what it is, and when it occurs. Capitalization is where the accrued and unpaid interest that is building up during school and your grace period is added back to the original principal amount that you borrowed, and that results in a higher base or a higher principal balance. For example, let's suppose that you borrowed $10,000 and that the interest rate was 10%, and let's suppose that the lender capitalized on an annual basis. Using some easy math, that would mean that after 1 year, you would not only owe the $10,000 that you borrowed, you'd owe an additional $1,000 in interest. If the lender capitalized annually, they would take $1,000, add it to the original amount that you borrowed, and now your principal balance is $11,000, and that is what they would start charging the interest rate of 10% on. So you can easily see that the less often capitalization happens, the better. Capitalization usually occurs at repayment, for example, at the end of the grace period. It is not occurring all throughout school, so don't be overly concerned about that, but it will occur at the end of your grace period. Simple example, your direct unsubsidized, let's suppose you take one out your first year of dental school, and let's suppose dental school takes you 4 years and the interest is building up during the 4-year period of time and also during the 6-month grace period. Capitalization will occur. All the interest that built up over the 4 years in the grace period will be added back to the original amount that you borrowed that first year when you enter repayment after your grace period. Capitalization also occurs when borrowers who are using an income-driven repayment plan that we call IDRs, like pay and repay. It occurs when borrowers who are using an income-driven repayment plan either switch plans or are late recertifying their payment amount with their income plan. We have a separate module on the ADEA site on the income-driven repayment plan. So once again, very important that you understand capitalization, what it is and when it occurs. Now, the majority of the loans that you will be taking out for dental school are federal direct loans. This would be your direct unsubsidized and direct plus. And once again, for many of you, this is all you will be taking out every year. The rates are fixed, but listen carefully. The rates change on new loans dispersed on or after July 1 of any given year, and then they remain fixed for the life of the loan on that particular loan. What does that really mean? That means if, for example, you took out 4 direct unsubsidized loans over the course of dental school, you could end up with 4 different interest rates on those loans, because once again, the rates change on new loans dispersed on or after July 1 of any given year. Your financial aid office should be notifying you of what the interest rates are. They're usually announced late May or early June before the rates go into effect on new loans on July the 1st. Please note that the maximum rate on new direct unsubsidized loans is 9.5%, and the maximum rate on new direct plus loans, also called Grad Plus, is 10.5%. So very important for you to understand the interest rates, how they work on your federal direct loans. Let's take a look now at the interest rates on what are called campus-based loans. These are loans that are originated and dispersed by your school. Some of you may have federal Perkins loans. It is unlikely you will receive them during dental school because this program is being phased out. But if you have any federal Perkins loans, the rate is 5% and the rate is fixed. Health profession student loans, called HPSL, they also have a 5% fixed rate, as do loans for disadvantaged students, known as LDS loans. Institutional loans, these would be loans that come directly from the school, perhaps because of a donor or someone who's given money to your particular dental school. Those rates will depend on the terms assigned by the school. Your school may not have any campus-based loans, but very important for you to talk with them about campus-based loans to see if they have any availability and to always be sure that you apply on time. So these are campus-based loans: federal Perkins, HPSL, LDS, and institutional loans. Now, some of you may have private loans from college or perhaps a post-bac program, and some of you may be actually considering taking out a private loan for dental school in lieu of or in addition to federal student loans. We would strongly encourage you to talk with your financial aid office before you take out a private loan for dental school. But if you have a private loan or are thinking about taking one out, they will have fixed or variable rates depending on the lender and your eligibility. If you happen to have a private loan with a variable rate or are taking one out that has a variable rate, be sure you know how often the rate can change and how high that rate can go. Interest rates have changed on variable rate loans several times over the past year. So very important for you to know how often it changes, how high the rate can go, and the impact of the rate change on future payments, and especially how much notice you get about future changes in your payment amount. And also be sure to ask about the frequency of capitalization on private loans. Private loans are unsubsidized, so interest will be accruing during school and any grace period they may allow you. So very important to understand the interest rates on your private loans. Now, this table reflects the recent and current interest rates on federal student loans, direct unsubsidized and direct plus. And one of the first things you'll notice is that the interest rate on direct plus is always a full point higher than the interest rate on direct unsubsidized. And you can see how the rates have changed each year on new loans. Remember, the interest rates change on new loans dispersed on or after July 1 of any given year. And for example, if you are a graduate in the class of 2019, you're graduating in May or June of 2019, if you took out 4 different direct unsubsidized loans, one each year, each one of those loans has a different interest rates. The rate should be clearly indicated on your loan servicer's website. We close this module on interest rates with some common sense tips on how to negate the impact of interest rates and capitalization on the total repayment amount of the loans you take out for dental school. First of all, never borrow more than you really need. You've heard this before, but just because you can borrow the full cost of attendance each year in dental school with a combination of direct unsubsidized and direct plus, that doesn't mean you have to. Remember, the interest rate on direct plus is a full point higher than the interest rate on direct unsubsidized. So if you don't need to take out a grad plus loan, or perhaps you don't need the full amount, don't take it out. If there's any way that you can help pay the interest on unsubsidized loans during school and grace, that will help reduce or eliminate the capitalization that will occur at repayment that we discussed on an earlier slide. Be sure that if you make any voluntary payments on your student loans, perhaps during a grace period before they come due, or once you start into repayment, if you put any additional payments or aggressively pay on your student loans, work with your loan servicer to be sure voluntary payments or additional payments over and above the minimum payment amount are targeted against your highest interest rate loans. Because remember, you have different loans at different rates. And if you're going to pay voluntarily or pay over and above the minimum amount, be sure you post those funds on the highest interest rate loan. And consider using aggressive repayment to shorten the repayment period and thus reduce the overall interest cost. For example, what if you ended up in a 25-year extended level repayment plan? That doesn't mean you have to stay in the plan over 25 years. If you can accelerate payments, you can shorten the time period and reduce your interest costs. So some common sense tips to negate the impact of interest and capitalization on the total repayment of the student loans from dental school. Thank you for watching this interest rate primer. Remember that responsible borrowing leads to responsible repayment. On behalf of the American Dental Education Association, good luck with dental school.